The one thing that I wish I knew 20 years ago when I first started investing, this one thing would be buy companies below their price to earnings growth rate. Or find a company with a PEG ratio below 1. And what that means is you want to go look at, okay, what the primary factor that will impact a stock price the most is an increase or decrease in earnings per share. It's the delta, it's the change between current earnings and future earnings that dictates the price. All else being equal, that's the only thing that moves a stock. And you go look at a stock, go find a company that doesn't have any EPS growth, and you'll see a stagnant stock price for the most part. And go find a company with significant earnings per share growth, and you'll see a growing stock price. And so this explains why Charlie Munger, I believe, brought this intelligence to the Buffett partnership. He brought it to Berkshire Hathaway. Warren Buffett used to have more of a cigar butt investment approach, which was to find a dollar trading for 50 cents, pick it up. He equated this type of an investment to a cigar butt. You pick it up, you take a puff, and you throw it away. Because the cigar butt was cheap, it was on the ground for free. And so you pick it up, you light, I don't know why there's a used cigar butt, but anyway, you're smoking a used cigar butt and then you throw it away. And the intelligence that Munger brought to the partnership was that it was more intelligent to buy a company with significant earnings growth or a high return on equity and to pay a fair price than it was to find a fair company at an extraordinary price. And so this is the way to avoid a value trap. A value trap is a company whose stock price has recently declined, typically because of negative news. And because its stock price declines, its price to earnings ratio makes it look cheap. But earnings are reported on a historical basis. So sometimes earnings will then be reported in they'll catch up over the next 12 months and they won't be as rosy. Hence the reason for the original stock price decline. But then when they're not as rosy, turns out your price to earnings ratio that you paid wasn't so cheap, and then suddenly the PE ratio increases as a result of a deterioration in the underlying earnings. And this is why Buffett tells his managers to go buy a company below a PE of 15 where there is a 90+% chance statistically of higher earnings in the next year. It's because the higher earnings dictate the stock price. And so when you look at the vista of available investments to buy, you'll see companies that trade at 7 or 10 times earnings. And they might look cheap relative to a company trading at 20 times earnings. But if the company trading at 20 times earnings is increasing EPS, earnings per share, at 30% per year, you would much prefer to buy a company with a double-digit EPS growth rate in excess of the price to earnings ratio than you would to buy a company with a low PE of 10 with nominal or limited EPS growth. And this is the brilliance of Peter Lynch, who ran Fidelity's Magellan Fund and produced a compounded annual growth rate of about 30% during his tenure. It's because he, I believe, professionalized this idea, which was to buy growth at a reasonable price. If EPS growth is the primary determinant of future stock prices appreciation, then you want to buy growth and you just want to make sure that you're paying a reasonable price. So as a value investor, which is a difficult term to use in the modern day of the past decade and a half of zero interest rate policy, when there's free credit, it doesn't really, prices in value investing and valuation become more of a tenuous exercise of limited benefit. But I believe that, you've had interest rates that have risen in the past 18 months or so. And now you see this recession discussion popping up again. I believe that at some point in the future, there will obviously have to be a correction in prices. The total market cap to GDP ratio is back up to all-time highs. You know, the market is probably the most overvalued it's ever been. Doesn't mean that prices can't stay elevated. So you have to be intelligent. But regardless of trying to predict future market prices, etc., when you think like business owners, we're not concerned with buying and selling. We're just concerned with buying and owning. We're business owners. The stock market is just a conduit for buying good businesses. And so when we go look for good businesses, I believe that it's far more important to buy a good company, and you want to look for a PEG ratio below 1, which is a method to determine that you're paying a reasonable price for the earnings. And to give you an example, what you want to do is you want to just maintain a list of companies that are first-class companies, which you'd characterize as having significant, stable, growing revenue and earnings, large margins, high returns on invested capital, limited debt, offered at a reasonable price. And if you put together a list of these companies, the prices will fluctuate, and eventually, for some reason or another, you will find them available for sale at a price that at some point becomes attractive. And to give you an example, at the beginning of 2025, when the S&P 500 traded at an earnings yield of about 3.5% against a 10-year treasury of 4%, meaning that the risk-free rate, another conversation, risk-free, the debt is made up. It's all, anyway, risk-free. Except notwithstanding that money is credit made at will and they can print more and it results in inflation. But this is not what they teach in business school. Anyway, the risk-free rate of treasuries was 4%. The earnings yield of the S&P 500, meaning the 500 companies, the index's earnings divided by its price, offered a 3.5% earnings yield. And therefore, there was no equity risk premium, no incentive to go take risk by buying stocks. And of course, Trump rolled out tariffs and stock prices declined. All right, where was I? I had to grab a charger. So Trump rolled out tariffs and stock prices declined. Now, you could argue that for fundamental reasons of valuations being ridiculous, they declined, or tariffs, they declined. But in either scenario, stock prices declined. And NVIDIA, for example, which is a hot name in the modern day, growing, its earnings per share is growing at 80% per year. Suddenly it traded at 32 times earnings. And so you'd say a PE ratio of 32 is preposterous. Except when you look at the underlying company, its earnings per share is growing at 80% per year. So its PEG ratio was 0.5. So here's an example of how this applies. And NVIDIA traded at 32 times earnings during the downturn. And now it was about $100 per share. 96, I believe, was the low. And now it trades at 178. So here's an example of how you can capitalize. You keep a list of good companies that you want to own. You wait till you see a PEG ratio below 1 on these first-class companies, and then you buy and you think like a business owner. We're not concerned about selling. You just buy and own. But this is the one thing that will help you value investors refrain from just buying a company because it's cheap. You want to buy growth at a reasonable price because growth is what causes stock price appreciation for the most part. If all else is equal, notwithstanding earnings, a price to earn, a multiple expansion, or notwithstanding other changes in the stock, if nothing else changes, it's only the change in earnings per share that causes a stock price to go up. So you want to focus on earnings, but you also want to buy earnings at a reasonable price, and buying a company below its price to earnings growth rate is a way to do that, and it'll prevent you from buying companies that appear cheap that end up being value traps, etc.